Welcome to House Lux Estate, your trusted guide in the realm of real estate and investment. We're here to offer you sharp insights and simplified explanations to help you navigate the often complex landscape of investment opportunities. Today, we're going to delve into an essential tool for any investor, bond ratings. Now, you might be wondering, what exactly are bond ratings? Good question. Bond ratings are a grade given to bonds that indicates their credit quality. They're like a report card for bonds. A high rating means the bond has a lower risk of default. A lower rating indicates higher risk. Understanding bond ratings can be the difference between a wise investment and a risky gamble. But don't worry, we're here to make this complex subject simple and understandable. Stay tuned as we dive into the process of interpreting bond ratings in a simple and understandable manner. Before we delve into interpretation, we first need to understand what bond ratings are. So imagine you're at a fancy dinner party. The conversation turns to investments and someone drops the term bond ratings. You nod along, but inside you're thinking, what on earth are bond ratings? Let's break it down. Bond ratings are like the report cards for bonds and their issuers. They show the creditworthiness of corporate or government bonds. In simpler terms, they tell us about the financial health of the entity issuing the bond. Now, why are they important to investors like you and me? Well, they give us an idea of the risk involved in investing in a particular bond. A high rating indicates a lower risk of default, meaning the bond issuer is more likely to meet its payment obligations. On the other hand, a low rating signifies a higher risk of default. Think of it like this. Let's say you're lending money to a friend. If this friend has a history of paying you back on time, you'd probably feel comfortable lending them money again. But if they've been unreliable in the past, you might think twice, right? Bond ratings work on a similar principle. So, who hands out these ratings? That would be credit rating agencies. The big three are Standard & Poor's, Moody's, and Fitch. These agencies use a combination of letters, numbers, and symbols to grade bonds, with AAA or AAA being the highest rating and D being the lowest. These ratings are not permanent, though. They can change based on the issuer's financial situation. So if a company starts performing poorly, its bond rating could drop. And if it starts doing well, the rating could rise. Bond ratings are crucial tools for investors. They help us make informed decisions and avoid unnecessary risks. It's like having a crystal ball that gives you a glimpse into the financial future of a company or government. Now that we know what bond ratings are, let's explore how to interpret them. Bond ratings may seem like a complicated alphabet soup, but once you understand the system, it's quite straightforward. So, let's dive right in. Picture bond ratings as a scale, starting with the highest quality bonds, those that are rated AAA. These are the bonds issued by entities that are most likely to fulfill their financial obligations. It's like having a student who always hands in their assignments on time and aces every test. They're the valedictorians of the bond world. Then we move down to AA, A, and BB. These are still high-grade bonds, but each step down the ladder signifies a slightly higher level of risk. It's like moving from the honor roll students to the ones who occasionally miss a homework assignment, but still maintain solid grades. Below BBB, we enter the realm of speculative grade or junk bonds. These include BB, B, CCC, CCC, and C. The further down we go, the higher the risk. These bonds are like the students who are struggling to pass. They might still pull through, but there's also a chance they might not. Finally, at the very bottom of the scale, we have D-rated bonds. These are bonds that have already defaulted, meaning the issuer has failed to meet their financial obligations. They're the dropouts of the bond world. Each of these ratings can also be modified with a plus or minus to indicate their position within that category. For example, a bond rated A+ is considered to be at the higher end of the A category, while an A bond is at the lower end. With this knowledge, we can now proceed to interpret these ratings. Remember, just like in school, the higher the grade, the better the performance. But also remember that higher grades often come with lower yields. So it's all about finding the right balance between risk and reward. And that, my friends, is the alphabet of bond ratings. Interpreting bond ratings is an essential skill for any investor. It's like learning a new language, where each letter and combination provide a snapshot of a company's financial health and the risk associated with their bonds. Let's dive into the step-by-step process of interpreting bond ratings. First off, it's important to understand what each rating represents. Ratings from AAA to BBB are considered investment grade, which means they are viewed as having a low risk of default. Anything rated BB and below falls into the category of speculative grade or junk bonds, which carry a higher risk of default. Now let's take a closer look at the issuer's financial health. This is a crucial component of the rating. Analysts will examine the issuer's balance sheet, income statement, and cash flow to evaluate their ability to repay the bond's principal and interest. For example, a company with high levels of debt and low cash reserves may receive a lower rating, indicating a higher risk of default. Economic conditions also play a significant role in bond ratings. In a booming economy, businesses generally perform well, which is reflected in higher bond ratings. Conversely, in a sluggish economy, companies may struggle, leading to downgrades in their bond ratings. Therefore, as an investor, keeping an eye on the broader economic landscape can provide valuable insights into potential rating changes. The rating agencies also consider the issuer's industry sector. Certain sectors are more susceptible to economic downturns, regulatory changes, or technological disruptions, which can negatively impact the issuer's ability to meet their bond obligations. For instance, a tech company might face different challenges and risks compared to a utility company, and this would be reflected in their respective bond ratings. So far, we've discussed the issuer's financial health, economic conditions, and industry sector. But there's more. Rating agencies also look at the issuer's management quality. They assess the competence, experience, and strategies of the management team, which can significantly influence the company's future prospects and its ability to repay its bondholders. Finally, it's important to remember that bond ratings are not static. They can change over time as new information becomes available or as conditions change. Therefore, investors should monitor any changes in bond ratings as they could impact the investment's risk and return profile. Interpreting bond ratings may seem daunting, but with practice, it becomes second nature. And remember, while bond ratings are a useful tool in assessing risk, they are only one piece of the puzzle. As an investor, it's important to conduct your own research and consider a range of factors before making your investment decision. We've covered a lot today, so let's summarize the key points. Firstly, we dove into what bond ratings actually are. These are assessments provided by independent agencies, evaluating the credit risk of a bond issuer. Remember, the higher the rating, the lower the risk, and vice versa. Next, we decoded the alphabet of bond ratings. The three main credit rating agencies, Moody's, Standard & Poor's, and Fitch, all use slightly different scales, but they all follow the same general principle. Ratings range from AAA or AA, which denotes the highest credit quality, to D or C, indicating default or imminent default. The middle ground BBB or BA and below is often considered speculative grade or junk bonds. In our third segment, we delved into interpreting these bond ratings. Remember, a high rating is not a guarantee of a good investment, nor is a low rating an automatic red flag. It's about understanding the risk and reward balance. A higher rated bond means lower risk, but also typically lower returns. Conversely, lower rated bonds, while riskier, can offer higher yields. We also emphasize the importance of not relying solely on bond ratings when making investment decisions. They are a tool, a starting point, but not the be-all and end-all. Other considerations, like the overall state of the economy, the specific industry of the issuer, and your personal investment goals and risk tolerance, should all factor into your decision-making process. And finally, we discussed how bond ratings can change over time. An issuer's financial health can improve or deteriorate, leading to rating upgrades or downgrades. So it's crucial to stay informed and regularly review the ratings of the bonds in your portfolio. Remember, bond ratings are just one tool in your investment toolkit. Always conduct thorough research before making any investment decisions. Thank you for tuning into House Lux Estate. Remember to subscribe and stay informed.